Always a pleasure to visit with you about the ag commodity trade. I'm Marlon Bowling with you. Don't miss our Facebook Live with John Jenkinson and myself each afternoon as we analyze what we have been hearing from all the analysts that we talk with during the course of the day. We kind of recap everything in our afternoon update. And also, we have our Commodity Wrap show on rural radio. That's on Sirius XM, channel 147, every morning and every evening. We do editions, half-hour in-depth interviews with market analysts. The one in the morning comes on at 8:30 Eastern Time. The one in the evening, 5:30 Eastern Time. And you want to check that out for in-depth analysis, half-hour long each program. Let's take a look at some brand new information that just came out. It is our new ethanol production for last week. Let's take a look. In the U.S., we had a total of 1.033 million barrels per day, and that was up just one little scotch from what we had the week before when it was 1.030. So that was an increase of 3,000 barrels per day. The 4-week average bumps up to 1.02 million barrels per day. Ethanol stocks actually declined. They went down about 500,000 barrels to 20.5 million, and we had just a little tiny bit of imports, 4,000 barrels that were imported into the U.S. Last week. All right, let's go see what's going on at the trading floor and welcome Scott Gecas to the show. He's with the Fox Group, and he joins us to share his perspective on the grain trade here so far today. What's going on from your angle?
Well, I mean, we're looking at a lot of different things. So the delay in trade war talks is definitely having a huge factor across the markets, just across the board. So with the beans, you have the weather that's affecting harvests across the board as well as in the grains. You know, the harvest is anywhere well below the 5 to 10 year average. So that's definitely significant. So there's a little bit of downside pressure on the beans as far as the option flow. The market's really not looking or affecting that way. So you're seeing beans up a little bit, corn's down a little bit. But what we're looking at is the option flow. So the option flow in the beans, the 900 calls traded 500 times on the open. That's significant just because that's a sizable order for the options, not necessarily for the futures, but for the options, which is suggesting that we're looking for a little bit more downside movement. So we're looking at support around 901 in the beans. Now, corn is a completely different story. So we had North Korea as well as India tender some corn. So domestic demand as well as international demand is starting to pick up, and that's also confirmed by the option flow. 2,200 calls traded on the 390 strike in the January options. Now, why that's significant is because the open interest is only about 6,000. So that's significant. With the demand picking up a little bit, we expect corn to start getting a little bit more upside pressure. It's really not acting that way right now, but with the option flow, we expect it to happen in the future. So we're going to go back and forth with both ways. We're definitely keeping an eye on the flow. That's going to give us a little bit more indication of where prices are going to be.
Interesting that there's so much interest in the use of options. I actually like seeing that. Let's take a look at the corn futures right now. And, of course, this is what the options are based on. Right now we have December corn down 2.5 cents. We're at 367.5. And in the soybean trade, they've really quieted down here. Soybeans on January now up a penny at 912.5. And kind of in the middle of our trading range. On the wheat market in Chicago, we have that December contract to higher. Actually, July is down 1/4 cent at 521. Kansas City, by the way, has December trading a little higher. We're up 2 there at 427 3/4. July up a penny and a quarter. Minneapolis wheat on that December contract is down 1 lonely tick right now. We'll come back in a moment and talk more with Scott Gecas about livestock when we come back. Well, let's dive into our livestock discussion. Let's dive into live cattle first. And on the live cattle, we are lower across the board. And we have December down 53 cents. We're at 118.25. February is still kind of weak in the knees. We're down 47 cents at 124.58. And if you look at our feeder cattle market, right now, as we get into the mid-session here, November is up 15 cents. That one goes off the board tomorrow. January down 53, and it's trading at 143.50. I want to go back to Scott Gecas there in Chicago. He's with the Fox Group. When you have a contract such as November feeders going off the board tomorrow, does that have any implications on the way things behave here today?
Oh yeah, for sure, because everyone's got to reposition their futures. So you're going to have that roll where if they're long, they have to sell the short, or they have to short the front month and then buy the back month, and it's a big dynamic that is going to move. We expect volume to pick up a little bit as that roll comes off. So, but as far as the cattle goes, it's really odd. So we have strong demand, strong exports. However, we're looking forward to the cattle on feed report tomorrow. If we have higher than normal placements, that's going to be viewed as bearish. So we're going to be keeping an eye on that, and that's one of the reasons why you're seeing a little bit of downside pressures, because the market is expecting a little bit higher placements than normal. Early estimates are roughly around 10.8% or so. So that's what we're going to be focusing on that.
All right, on the lean hog trade today, we've had a really down week here overall in the lean hog complex. Let's take a look at our futures. Nearby December is currently down 90 and it's trading at 61 and a quarter. We have February down $1.33. We're at 68.30. Where is the bottom? Where is the support here, Scott, on this hog trade?
Well, the hog trade is completely going to be determined on this trade deal. So we're seeing a lot of downside pressure just because of the delay in trade war talks. Trump's saying that he's threatening with more tariffs. We have higher weights, higher slaughter rates, near record highs. So it's really going to be a determination of whether or not we can get that trade war done. So if we get that trade war done, we expect the exports to pretty much explode, have that China import campaign pretty much ramp up. So we just have to wait and see what those are going to be. But right now, the fundamentals, we have supply concerns, lack of exports. So that's why you're seeing a lot of downside pressure.
Okay, thanks for explaining everything, and good to visit with you again, Scott Gecas. He is with the Fox Group right there in Chicago. Tammy?
All right, thanks.